Let's now get into the advisory and why long-term thinking wins in investing. Glenn Fairbairn now joining us from Hewison Private Wealth. Glenn, welcome to Ausbiz. Long-term thinking, I guess any investor can be guilty of not doing that we're very much focused on the short term and reacting to the news cycle. How difficult it is to break out of that?
Oh, look, it's very difficult, Andrew, in particular in today's day and age where we're bombarded with information, whether that's social media or mainstream media, even looking at the current state of markets where there's ongoing discussion around interest rates, inflation, more recently with the Trump tariffs, even our own federal election coming up. There's a real danger to be very reactive to these news stories, and that can be quite dangerous, and it can impact returns over the long term.
Yeah, so this is all what we would call market noise then. How do you filter that out though?
As I said, it's very, very difficult, and that's where it's important to have a strategy, in particular when you're building a portfolio for the future and to perhaps help you provide for your needs in retirement. It is important to understand what your objectives are, what you're looking to achieve, and having a very clear strategy that can help you achieve those objectives. That way, you can be more in control of your strategy and be proactive with your investment decisions, as opposed to taking too much notice of what's happening in the short term and being very reactive. So without a strategy, it is very dangerous, and you do fall into the trap of jumping at shadows a lot of the time with what's happening in the market.
Yeah, I guess the last thing you want is to make those decisions on an emotional basis, which can be tempting short term and perhaps being more speculative and, as you say, overreacting. So what are some of those strategies then you can use that would favour long-term investors?
Yeah, look, as I was saying, very important to have a clear strategy, and that involves having a diversified portfolio of assets. So not having all your eggs in one basket, spreading your portfolio across different types of asset classes. That way, if there is an equity market downturn, you're not going to feel the full impact of that. The importance of that strategy is that when markets do fluctuate, and if they are volatile, the portfolio will be telling you what you need to be doing during those particular points in time. So if you sit down with an advisor and you develop a strategy that's appropriate for your set objectives and what you're looking to achieve, if the equity market does fall, then the outcome of that is that you're likely to be underweight shares. So if you're disciplined with your approach to managing your portfolio, more likely than not, you're actually going to be buying shares when perhaps other investors or speculators, those who are making irrational, emotional decisions, are probably selling. So once again, by having that diversified approach to investing, having a strategy and then sticking to it and being disciplined, that can really help you over the long term.
Glenn, there's that familiar refrain, it's not timing the market, it's time in the market. How true is that? I guess particularly when you consider compounding returns.
Look, the effect of compounding is very, very powerful, and history has shown us and data shows us that even over the last 10 years, if you simply missed the best 10 trading days, you could halve your investment return. So you could think that you're doing the right thing by selling out of shares in a falling market, but by doing that, the question always is, when do you buy back in? And quite often, by sitting on the sidelines and not being invested, you can miss out on those really strong trading days, and that can, as I said, have a very significant impact on the long-term performance of your portfolio. And that's where it is important to distinguish and separate between investing and speculating. Speculating is the more dangerous form of trading stocks or trading commodities or whatever it may be. Investing is identifying good quality assets, those that you are confident can withstand the short-term market shocks, and then holding them and giving them a chance, and that way you benefit as a long-term investor, and you won't be impacted by the short-term fluctuations in the market or the short-term downturns in the market.
Does it matter where you are in life, whether you're just starting out or perhaps you're close to retirement, of how you approach this, particularly if you're talking about longer-term strategies?
Yeah, look, it's a good question, Andrew, one that we get asked quite a lot with our clients. There is that natural reaction to perhaps go a little bit too conservative as you approach retirement. But the important thing to bear in mind is that even for someone who's perhaps retiring at age 65, they could have a 20 to 25 year plus investment time horizon. So it's not overly necessary to become too conservative. Look, there probably is a tendency to perhaps focus on more income producing assets, those that can generate cash flow, that can meet and maintain what you need to live on an annual basis. But I would caution, those who are perhaps approaching retirement from becoming too conservative. There's definitely no necessity to be aggressive and maintain an aggressive investment strategy. But once again, that's where it's really important to speak to your advisor and make sure that the strategy that you've got in place is really appropriate for what you're looking to achieve in your retirement.
I mean, that's a natural tendency, though, isn't it? It's particularly when you're approaching retirement or in retirement, you want to protect your capital. Therefore, perhaps you do tend to be very defensive.
Absolutely, but then in that situation, perhaps you're taking that investment risk away, but then you're perhaps exposing yourself to inflationary risk. We've all seen in the last 5 years the impact of the rising cost of living, and if you were sitting on cash over that period of time, not only have perhaps you missed out on some really good equity market returns, but in real terms, because the impact of inflation is eroding the value of your capital, it does impact your ability to maintain the lifestyle that you want to live. So that's where, even if you are approaching retirement or in retirement, yes, you need those defensive assets that can provide that surety, but it's also important to be investing in assets that at least have the potential to grow, because we need to offset the impact of that real danger in retirement and that danger of living for a long period of time. We don't want to see our capital be eroded by inflation. So, at least investing part of your exposure in growth assets is very, very important.